In this video, we're going to do a comparison between the identified costs method versus the FIFO method. So remember, with the identified cost method, we value inventory by physically marking each item so that individual cost prices can be identified. Whereas with FIFO method, we value inventory by assuming first items purchased are first sold. Under the identified cost method, all the cost prices of the inventory coming in and going out are specifically identified. But on the other hand, with the FIFO method, we follow through a series of assumptions in recording the movements of the inventory. So the same idea applies here to inventory losses, inventory gains, and other out transactions. If the identified cost method is used, the inventory cost prices are individually identified. Whereas if FIFO method is used, we follow through a couple of assumptions to help us with the valuation of inventory lost, inventory gained, or perhaps inventory withdrawn for advertising or personal use. Because the two methods work differently, they both have different costs and benefits. With the identified cost method, the valuation of the inventory is more accurate and neutral. This is because each individual unit of inventory is specifically identified. However, this means that it is more expensive for the business to use this method. For example, the business needs to pay for labeling costs and invest in equipment and computer systems to track inventory movement. Also, it is not always possible to mark or label certain types of inventory, for example, fuel and fruits. On the other hand, FIFO is beneficial because it applies to all types of inventory, and it costs less to administer. However, FIFO is less accurate because we are not individually tracking the movement of inventory. Previously, we've been looking at the differences between the two methods in the way how inventory is valued and recorded in the accounts. We also looked at the different costs and benefits of the two methods. In the next section of the video, we'll be focusing on the differences between the two methods in the way they affect the income statement and balance sheet. We're going to see what happens if the cost prices are changing, and we're going to investigate the different impacts on the income statement, particularly the profits and balance sheet, with a focus on the different impacts on the inventory on hand if identified cost or FIFO method is used. Here in our inventory on hand, we can see that we have a mix of old and new batches of inventory, with the old batch of inventory having a cost price of $10 per unit, and the newer batch of inventory having a cost price of $15 per unit. Now we're going to sell 4 units. What we can see here is that we have a mix of old and new inventory sold. The cost prices of each inventory sold is identified. Now we're going to calculate the total cost of sales. 2 units sold had a cost price of $10 per unit, and 2 units sold had a cost price of $15 per unit. Therefore, the total cost of sales is $50. There are 2 units left on hand. One unit has a cost price of $10, and the other unit has a cost price of $15. Therefore, the total value of inventory on hand is $25. Now let's see what happens when FIFO is used instead. We're going to sell 4 units here. Now because we are using the FIFO method, we are assuming that the old inventory is sold first. This may or may not be the case when the customer takes the inventory. They could be taking more of the newer inventory or more of the older inventory. We do not know. We only make an assumption that the old inventory is sold first because we are using the FIFO method. Now we calculate the cost of sales. Because we are assuming that the older batch is sold first, we are calculating the cost of sales by taking 3 units at a cost price of $10 per unit and adding that to 1 unit with a cost price of $15 per unit. This gives us a total cost of sales of $45. Our 2 units left on hand have a cost price of $15 per unit, and therefore the total value of inventory on hand is $30. Now we're going to compare between the two methods and identify the different effects that they have on the income statement, which in other words are effects on the profits. So with identified cost method, each inventory sold was specifically identified. Using the example from earlier, the cost of sales calculated was $50. We compare this to FIFO, which assumes that the older batch is sold first, and the cost of sales calculated using the example earlier was $45, which is lower than what was calculated using the identified cost method. So overall, we can see that using the FIFO method, we will get a lower cost of sales. And the main reason is because we are assuming that the older batch is sold first, and therefore the calculation of the cost prices of the inventory sold will lean more towards the older batch cost prices, which was lower in this case. This same idea applies when inventory is taken out and used for advertising. So under the FIFO method, when the inventory is taken out and used for advertising, it is assumed that it is coming from the older batch, which has a lower cost price. And for this reason, overall under the FIFO method, the advertising expense will be lower than what it would be if the identified cost method was used. So overall, what we can see here is that if we use the FIFO method, it will give us a lower cost of sales and lower advertising expense, and therefore this will give us a higher profit in the income statement. What about the effects on the balance sheet? So looking at the FIFO method, the value of inventory that we had on hand using our example earlier was $30, whereas the value of inventory that we have on hand under the identified cost method was $25. So we can see that between the two, when the FIFO method was used, it will give us a higher value of inventory on hand. The reason is because with the FIFO method, we are assuming that the older batch is sold first. So logically, the inventory on hand at the end of the period would mostly be from the newer batch, which in this case had a higher cost price. So overall, we can see here between the two methods, the FIFO method will give us a higher value of inventory on hand. And therefore, if we look at the effects on the balance sheet, the assets are therefore valued higher in the balance sheet when FIFO method is used. The example that we have discussed earlier was based on increasing cost prices. But what if cost prices are decreasing instead? Well, the effects on the income statement and the balance sheet would therefore be the opposite to what we have discussed earlier. Have a think about this opposite situation using this slide as a prompt. Now we're going to look at the costs and benefits of using the perpetual system, which is basically the use of inventory cards to track movements of inventory. The perpetual system of inventory recording is basically what we've been doing so far, which is to use the inventory cards to track the movements of inventory. The steps in recording would be as follows. We would firstly record in the inventory cards, followed by recording in the accounts. And lastly, at the end of the period, we would do a physical inventory count. And at this point, this is where we can see if there is a difference between our physical count compared to what we have in our records. And if there's a difference, we can identify if there has been an inventory loss or inventory gain. With the periodic system of inventory recording, we do not use inventory cards. Instead, all inventory transactions are directly recorded into the accounts. At the end of the period, the business does a physical inventory count to calculate the inventory on hand at the end of the period. Alright, so let's test this out. So under the perpetual method, we are using the inventory cards to help us track the movement of inventory. So in our records, we can see that we had an opening balance of 10 units, a purchase of 20 units, a sale of 5 units, and therefore we can work out closing balance of 25 units. Then we do a physical count of inventory, which revealed that we only had 24 units on hand. This difference of 1 unit is therefore an inventory loss, which we have identified, and we can investigate the loss further. On the other hand, with the periodic method, we do not use an inventory card to track the movements of inventory. All we have is what we've recorded in the accounts. So here in our accounts, we can see that we had an opening balance of 10 units and a purchase of 20 units. But because we do not keep track of the ins and outs of the inventory, we do not know exactly how much we have sold. So what we are doing is to simply rely on the physical count of inventory on hand, which revealed that we had 24 units. The business would then use this as the closing balance. The number of units sold is calculated by taking the 10 units opening balance plus the purchase of 20 units minus the closing balance at the end of the period, and the business then assumes that the 6 units of inventory were sold. So you can see that using this method, we could not identify that there was an inventory loss of 1 unit. So here are some of the benefits of the perpetual system. Firstly, we can identify any inventory losses and gains. Secondly, we can reorder inventory as and when they are needed, therefore reducing the need to store too much inventory. We can also identify the fast and slow moving lines of inventory and therefore make decisions accordingly as to which inventory to purchase in the future. However, here are some costs of the perpetual system. For example, the business will need to pay more for staffing, training, and technology, such as the need for specialized equipment like scanners, IT support, and inventory tracking softwares.